Welcome to Thursday Night Stock Charts Live. This is Bob Desmond, and what we're going to be talking about tonight is Lululemon. What happened with their earnings, how the stock performing, and we're going to talk about where do I think the stock goes from here? Where is support? Where is resistance? And we're also going to talk about the market and how the market is changing and changing very, very rapidly. And I don't mean bullish versus bearish. I mean sector rotation. We've been talking about this for quite a while now, that the leadership groups have begun to change. We're going to talk about the Magnificent Seven stocks, and we're going to see how do they do today. We had the triple Qs up, so obviously the Mag 7 names must have been in fuego, driving the equity markets, or at least the triple Qs up higher. Maybe not. Stick around. We're going to go to those charts. So let's begin. We're going to talk about gold. We're going to talk about the dollar and what messages are they sending us. Why is gold up along with the dollar? What is going on here? Let's go. Let's begin with Lululemon. Lululemon. And before we begin, Lululemon, you have certain great individuals in the world, Gandhi, Mother Teresa. And in terms of products put out by companies, you have Macallan, a fine scotch. You have Lululemon. I mean, I don't wear them, but I certainly admire the product. When I'm at the gym, it's an amazing product, and bravo. 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 Thank you, Lululemon, for all you've done for humanity, and may you do so for another 100 years. So let's get to it. Let's get to the charts and get started. And what you're looking at here is the after-hours session of Lululemon. And they reported, obviously, we have a trade on here. We put on calendar spreads, very little downside risk. It was a directional play. We should make a couple of bucks, but not a big hit. First time I ever did a calendar spread, to be honest with you. So it looks like we're going to make a couple of bucks, but not a home run by any stretch of the imagination. We probably would have done better to the upside. And we'll go over the chart in a moment, because what this chart was telling you is that you must buy Lululemon, and it still might not be too late to get long here for a big upside move. And I'll tell you why in a moment. So Lululemon put sellers were annihilated after hours. The anticipated market maker move was about a $41 move. The shares closed at 483.72, and last tick was 428.26. So speculators that were out there that were selling puts, whether it be a vertical spread, whether it be just naked on the puts, they got wiped out. Unless they went twice the distance of the market maker move, then they'd probably be okay. But otherwise, if they just did the anticipated market maker move, they are just poof, moon dust. So they're going to have a bad time tomorrow. So the issue that came up with their report was that Lululemon sees Q1 revenue of $2.175 billion to $2.2 billion versus the high end of the range of $2.4 billion. So a measurable decline for Q1 revenue. But here's where I think that people get it wrong. They're thinking way too short term. They're forgetting about the macro view here. This is a very well-run company. I mean, a very well-run company. We're going to go to the Investors Business Daily stats on Lululemon in a moment. Obviously, you can tell I'm a huge fan of the product, although I do not wear them. The forward-looking guidance for the year, and this is where it gets interesting, and I think a lot of people just ignored this, and that's to our favor. This is what's going to benefit us, and that's that They see fiscal 24 net revenues at the high end of 10.8 billion. That's versus the estimate of 9.61 billion. So their forward-looking guidance on the year on revenues is actually higher. So everybody's paying attention to Q1. They should be paying attention to full year. So this this bit of a bloodbath, I think, is going to be short-lived. They did ratchet down. To be fair, their revenues are stronger versus estimate. However, their EPS is going to be lower for the year. I think that this is an opportunity, at least to sell puts tomorrow morning to get long. Now, let's talk about Lululemon a little bit more about their earnings report and what's driving it. And Nike, we don't care about. Lululemon's quarterly visit growth slowed to 20% for the most recent quarter versus a 39.4% increase for Q1. That's what's doing it there. That foot traffic is decimating the share price after hours. Lululemon same-store sales declines have slowed to 1.1% year-over-year decrease in February from 5.6% in January. That's actually pretty good. So Lululemon same-store sales declines. So they've been seeing declines, have slowed. So this is actually a bullish statement. So I think that this is going to be a short-lived opportunity on Lululemon. So let's talk about strategy. Where is support on Lululemon? And as a reminder, we closed out, or we currently are at, I should say, 428.3. Now let's go to a weekly chart. So right now, critical support is at 439. We're down here, just below it. Now, I think that if they sell off, which I predict that they will, sell Lululemon off. Normally what happens the next day after a bad earnings report, you'll get the sell-off. Then around 10:30 Eastern, maybe 11 o'clock, you'll get a brief counter-trend rally. That's some shorts taking some profits off the table. Then it rolls back over again. Then at around the closing hour, you see the shares drift back up again. That's more shorts booking profits into the close. So we'll see whether or not Lululemon is able to recapture 439. Is that accurate? 438. Let's call it 438 per share by the end of business tomorrow. If it does manage to close back above that mark, Lululemon may just be a buy at these levels, because keep in mind, now Lululemon's been consolidating here for a few months. They're going to take it to the woodshed tomorrow morning after it broke out last week. This week, continuation breakout. I may be speculating tomorrow morning here long of Lululemon. So members, stick around. I haven't found anything exciting to trade in the past week. I haven't done much. I just haven't done much. There's just been nothing exciting for me out there. Let's take a look at comments. All right, Franklin, welcome. Trader Isaac, hello. TZ Burton, hey, brother. Mr. Pete, welcome. Welcome. Gotta look. God made the hills, he made the mountains, he made the oceans, and he made yoga pants. God, there is a God. Talent. Okay, let's get to the economic data that has come out this week. And it's interesting stuff, man. Really, really interesting stuff that we had released this week. Home builder confidence actually increased. Housing starts, beat. Building permits, beat. We know about the FOMC rate decision. I think that they gave a little bit too much credit for Powell being dovish. I didn't hear that. Not as I heard dovishness. I saw the dot plot, all that nonsense. I didn't hear as dovish a message as everyone else did. So maybe I missed something. Apparently I did. We'll go to the CME Fed Watch tool because clearly expectations for a rate cut have ramped up, although they did decline today a little bit versus yesterday. Initial jobless claims missed. We're going to go to an article about initial jobless claims in a moment. Philly Fed survey came in less worse than expected. These are pretty good numbers. PMI came in a little bit worse than expected. Manufacturing, this is better than expected, and I believe that we were in contraction. Yeah. So a pretty good number on manufacturing. So tomorrow, I think the reason why we had a lot of lethargic trade today, because volume was terrible to the upside, is because you have Jay Powell out tomorrow making a statement about whatever, and a couple of other Fed heads after him playing cleanup just in case he makes a mistake. So I'm not sure why this volume is as light as it is, but we'll talk about that more in a moment. Let's talk a little bit about existing home sales. And the reason why I bring this up is that, yes, you always want to see the economy do well, but the problem is that this is inflationary. Right? You have yields that are not where they were 2 years ago when everybody refinanced or bought a home. Now they're locked into these very low interest rate mortgages. People don't want to sell. So a little bit of the headline here, a little bit more detail. Existing home sales soared to a stunning 9.5% month over month in February. That's very odd. I mean, that's February, smashing the expectation of 1.3% and building on the 3.1% month over month January. However, even with the big monthly jump, existing home sales remain down 3.3% year over year. So year over year, no bueno. Month over month, very, very strong numbers. But the problem is that people are paying more for these homes. Again, inflationary. So it's great if you're a homeowner and they're selling houses by you. It's great. Moving on to U.S. PMIs. So again, we just spoke about this briefly at the services and the manufacturing PMIs, Purchasing Managers Index. Unwelcome upward pressure. What does that mean? Well, it's on consumer prices. Consumer prices are feeling the pinch. S&P Global's U.S. manufacturing PMI surged to its highest in 22 months, while services PMI disappointed, sliding for a second month in a row, but still in expansion. Any read above 50 is a sign of expansion. So we're seeing pretty good data on the economic front this month, and that's on certain areas. That's month over month. Home sales are improving month over month, but down year over year. So some green shoots per se, maybe, but I don't think it's enough to say that we are avoiding stagflation, because where else do we see inflation? And people never, a lot of people don't get this. I should say people don't get this. That's not the right way to put it. But we're also seeing inflation is in the equity markets. Folks, we are at highs we haven't seen in the past 2-3 years on the Shiller PE ratio. We have a 35 handle on the Shiller PE ratio versus a mean of 17. So the market is very, very expensive. The S&P 500 is very, very expensive. So if you're putting new money to work here, you need to be betting on multiple expansion, betting that the economy is just going to grow gangbusters, and that will allow for the companies to sell more. Or you get multiple expansion due to the fact that the Federal Reserve is going to cut rates, thus improving the EPS, the bottom line for equities. I'm not in that camp that that's going to happen anytime soon. I'm just not in that camp yet, because they've been putting the carrot before the horse, the carrot and the stick approach before the horse for months now, and it's worked. So why are they going to raise rates with an economy that's supposedly growing? Excuse me, why would they cut rates? With an economy that is supposedly growing at 3.2%. I can't get that out of my head. Why would you cut rates? What's wrong? On a historic basis, interest rates are not high. So this past week, maybe even a little bit longer than that, I've been trying to rationalize the market and trying to position, because I still have a short position on the triple Qs. I haven't taken it off yet. I may need to, but I haven't yet. We still have longs. We're not net short. We have longs that are doing very well, but I still can't let go of that short yet of the triple Qs. And I'll go over the reason why in a moment. So let's talk about anticipated rate cuts going out and into June. And at current, we were down in the 60s on Tuesday. I think we were even down in the 50s on Tuesday. Now we're back above 70%. Now, for July, FedEx reported. I didn't take a look at that. I'm going to take a look at that next. We're going to be talking about the transports in a moment. I have them up here, right here. So for July, we're back up to 84%. Let's do a refresh here. If FedEx killed it, that can sway people. No change. Let's take a look at FedEx. No bid yet on Lululemon. More than likely what's going to happen here, before we go to FedEx, and this happens quite often, even if you move up on good earnings, even if you move down on bad earnings, same deal. We're going to flatline here into the 8 p.m. close for the after-hours session. Then we reopen at 4 a.m. Eastern Standard Time. This will probably drop lower into tomorrow morning. So if you're thinking about buying Lululemon, I would wait, because the probability of moving lower in the pre-market tomorrow is very, very strong, because you have a lot of institutions that may want to raise capital here and exit stage right. There's not enough liquidity right now to go dumping into this sell-off. They need to wait until tomorrow morning. So I would hold off, me personally. Let's take a look at FedEx. Wow. Let's get a feel for the weekly view, how we're looking. This is not reflective of the after hours change. Nice cup with handle formation. Now let's drill down, take a look at 15-minute view. Initially, they dropped this. No, that's not accurate. That's a bad tick. That's a bad tick. Okay. So here's the gap up here. That's a bad tick. Very, very nice. FedEx delivered improved profitability. $5 billion share buyback program. They did that because earnings jumped, but revenues fell, folks. They gave full year guidance. Apparently, the street's okay with it. Looks like they cut expenses. Street always loves that. So they raised guidance. Okay, fiscal year update, fiscal year EPS guidance to 17.25, high end to 18.25 version. Wow, big beat on EPS guidance. Permanent cost reductions. Solid quarter. Solid guidance, solid quarter. Okay. So I think this is probably going to be a green light for the the transport sector. So FedEx on our watch list. Let's get back to it. All right, Federal Reserve's balance sheet. You would have thought that after yesterday's presser that the markets, well, the Federal Reserve would have increased their balance sheet or slowed the rate of selling of their assets. They did not. They rolled off a good amount of debt off of their balance sheet last week. So the reason why the markets are rallying is because of renewed hope for June and July rate cuts and a hope that the Federal Reserve would stop doing this. They would stop rolling off debt off of their balance sheet. So that didn't happen last week. Now, moving on. Today was an event. We just witnessed history. The S&P 500 has officially added $10 trillion in market cap since its October 27th low. We're up 1,150 points or 28% since October the 27th. In other words, the S&P 500 just added roughly 4 times the market cap of Apple in just 5 months. AI hype and Fed pivot hopes are literally adding trillions in market cap for stocks. How high can this go? That's the $600,000 question, right? How high can it go? What you need is a dose of reality. And the dose of reality is going to come in the form of a hot CPI number, a big breakout in oil prices, a moonshot higher in gasoline prices. These are all numbers that are visible to the American public every single day. They drive past that gasoline station and multiple gasoline stations every single day. And gasoline is in fuego. So it's going to take an event, an awakening that these rate cuts, which they have forecast January, nearly 100% probability of a cut, March, nearly 100%. You have rate cuts as far out as the eye could see, yet you have the economy still growing. Why is it growing? It's only growing because the government is borrowing money to create GDP. Yet it's not a dollar for dollar return. They're not taking $1 and getting $1 of GDP. They're taking $1, spending it, maybe getting 20 cents of GDP. It's just unsustainable. But that's the reality. We live in a period right now where it is sustainable and the king wears no clothes. It's as simple as that. Let's talk about the structure of the market. And this is what's been fascinating me to the point of just being silent, to the point of not engaging all that much until I get a firm read of what we're seeing in this market, because we can go to the chart of the S&P 500, the triple Qs over the past several weeks, and we've broken down, at least on a daily time frame, multiple times out of an ascending wedge formation. You would have thought we were going into correction. However, we bounce back. It's the Michael Myers of bull markets. It just doesn't want to die. Michael Myers, for you youngins out there, look up Halloween, the original Halloween, and a couple of the subsequent ones. Michael Myers, the initial Halloween was the best. Jamie Lee Curtis, God bless you. Anyway, I digress. So let's talk about new highs, new lows, weekly chart, NASDAQ. Not great. You're not seeing a broad-based amount of new highs on the week for the NASDAQ. We're actually down. Think about it. So you have the triple Qs going like this, yet new highs are going like this. But the same can't be said for the New York Stock Exchange weekly chart. A massive amount of stocks have broken out to new higher highs. We've been talking about this. I've been saying at worst, we're going to get a correction. At least we are going to get sector rotation out of the triple Qs. And we'll talk more about that now. And I'm not even just talking about the triple Qs. I'm talking about the Mag 7 names. The triple Qs, I'll show you right now how the Mag 7 are really no longer leading the triple Q names. Case in point, take a look at, here's the triple Qs on the day. They were up less than a half percentage point. Okay, so what are the biggest components of the triple Qs? Apple, Microsoft. Those are the two biggest. Then you have Meta, NVIDIA, Microsoft. I already said Microsoft. Google, Amazon. What am I missing here? I'm missing another one. I know I'm missing one. But anyway, you get my point. And so how did these names, Tesla is what I'm missing. How did these names do today? We'll go to that in 1 second. In fact, let's do it now. So let's begin with the largest component of the triple Qs, or the second largest, I should say, Apple. Apple was down over 4% today. Antitrust concerns. And it's going lower. This is breaking down, and breaking down very, very hard. So I do not think that this is a one-day event for Apple. I mean, this is bad. This is, if we close out the week where we are at current or worse, look out below for Apple and quite possibly for the triple Qs. These are the generals. So on the week, you have Apple down just shy of 0.75%. Back to the daily chart. Google, how did they do today? Let's be curious. Oh, they were down. Remember, the triple Qs were up on the day. But you have Apple down, Google down. What did Tesla do? Tesla down. Tesla's down. Meta was up consistent with the triple Qs. Okay, that's fine. Amazon, a push, flat. NVIDIA. Okay. It's very, very difficult to have Magnificent Seven when you only have a couple of these names that are driving the triple Qs up higher. But is that really the case? No, it's not. That is beginning to change, because when you take a look at the QQQE, the NASDAQ 100 equal weighted, remember, the triple Qs are market cap weighted. So Apple, Microsoft get the biggest weighting. They're the biggest companies, so on and so forth. But what if all of these companies are equalized, the same weighting of that portfolio? Well, you had the triple Qs today, which were up 0.47%, but the equal weight was up 0.69. What does that tell you? It tells you that you're getting a broadening out of stocks in the triple Qs that weren't participating and are now participating. Here's a chart. Here's the triple Qs, or the QQQE, the equal weight versus the triple Qs. Now, still, clearly, the triple Qs are the 800-pound gorilla. They're still dominant. But something strange happened back here in October, right when this rally began. October of 2023. Remember, we've run up over 1,000 points, 1,000 S&P points since this bottom on the QQQE. We've stopped going down. On a relative basis versus the Qs, we have stopped going down. No new lower lows. And we were talking about this breakdown back here. No new lower lows. So we could see the possibility of a breakout at some point in time of the QQQE, the equal-weighted basket versus the Teslas, the Amazons, the Apples of the world. So we may see a new group of leadership, but it'll be a lot more stocks driving that sector up or that index up higher. The only problem is that the NASDAQ as a whole, you're not seeing a lot of new highs out there. That's a problem. Now, where else are we seeing money flow into? We just went over FedEx, right? The Dow transports are looking the bomb. They're looking really, really good. I'll take you through a weekly chart first here. And that's the wrong chart. Here's the weekly view. This is a beautiful, beautiful setup. And if we close where we close today, tomorrow, that's a breakout on the Dow transports. So this is a screaming buy. The Dow transports appear to be a screaming buy. There's a problem with that. If you have the Dow transports that are breaking out, if you have, as we've talked about many times, the CRB commodity basket breaking out, of which it already has, that broke out a few weeks ago. That's a problem. That's a problem. What's it a problem for? It's a problem for this. Anybody expecting these rate cuts? How do you have inflation, GDP growth, a breakout in commodities, and a breakout in the Dow transports and still cut rates? I don't know. I don't know how you do that. And what's been really getting me this week, and I have a tendency to get real quiet when I'm trying to figure stuff out. And I think what the dollar is doing, because this has really caused me a lot of consternation over the past few days. I watch currencies all the time. I don't trade them. I trade them vertically in a way, I guess you will. I trade gold, silver, gold stocks. So that's relying upon knowing where the dollar is going to go. And I'm very bullish on gold and silver and the gold stocks. There's only one problem. I'm also bullish on the dollar, the chart anyway. I don't believe the dollar should be going up higher. I'm starting to change a little bit. The reason is that I'm seeing transports break out. I'm seeing commodities break out. And I think what the dollar is doing is calling BS on the Federal Reserve. It's saying, no. You're not going to do this. You're not in January of this year guaranteed to cut rates. December, guaranteed to cut rates. It ain't going to happen. Not unless there's an event that takes place that demands that the Federal Reserve cut rates. That, my friends, I think is the problem for the equity market. The other problem for the Federal Reserve is this, and it's a political one. We're long of gold. I love the fact that gold's breaking out. It's great. Love it. Woo! But it's horrible. It's horrible for the Federal Reserve because it's a PR nightmare. Why is gold breaking out? It's breaking out because there's no confidence that the Federal Reserve is going to do the right thing and do what they should do if we truly do have expanding GDP, and that is to raise rates. They should be raising rates, not cutting rates, raising rates, or at least not promising to cut rates. So I think what we have here is a tug of war between the currency markets, the Federal Reserve. I don't think Congress even knows that they're alive right now. So I have little faith in Congress whatsoever. But clearly we are seeing sector rotation. I mean, look no further here than to the banks. The banks are at all-time highs. Even look at the KRE, the regional bank index. That's up about 3.75%. This time last year, we were in free fall. Now, we're threatening to recapture those prior highs. Let's check out high yield debt. High yield debt's breaking out. So can we see a continuation move up higher in the equity markets? Sure. But as we continue up higher, we run the risk of a black swan event. Let's take a quick peek at the yield curve. I believe it contracted today. Yeah. Yeah, it contracted today. So that gave the green light for the equity markets to move up higher. So let's talk about the weekly charts for a moment. And are we really going to see lower yields? Now, right now, you're looking at a chart of the 10-year yield. And we are down about 0.75% on the week. The week is not over. We are off the lows of the week. And frankly, folks, we are very, very close to a breakout on the 10-year yield. And if we do break out, that puts into question whether or not we are going to take out prior highs at around a 5 handle on the 10-year yield. Now, on the day today, the 10-year pulled back slightly, but closed well off the lows of the week. Also take note that we broke out a few days ago on the 10-year yield. We also have the 50-day moving average in blue rising up to the 200-day moving average in red. Do we get a bullish convergence of the two? If so, that will be a very bullish event for the bond price, bond yield, not the bond price, bond yield. And for bond prices, this is a 20-year. The 20-year is hanging on by a very thin thread. So these charts are not screaming to me that they believe that the Federal Reserve is going to be cutting rates. That may change tomorrow for all I know, but I can only trade the market I see. And when I go putting more capital to work here in this equity market right now, no, I wouldn't. Would I short it? No, I have a short on. I'm not going to go adding more to that short because it's wrong right now. I'm wrong. So I have to consider taking it off, to be honest with you. If they continue to just melt up higher, we got to take it off. And I still have longs on, and they're doing well in energy and consumer staples. Those are doing well. But this needs to get resolved. And I think what we may be falling into, and this may be the sweet spot for the equity markets, is that what if there is no resolution? Like me, I'm like a bull in a china shop. I need resolution, either a breakout or a breakdown. But what if we don't get that? What if, going back to the 10-year yield, what if, monthly chart, we just stay in this trading range that we've been in for the past 2 years, going on 2 years? Is that possible? Sure. Is it likely? Not if inflation keeps up, but if inflation stabilizes, I think that we can stay in this trading range, and that will allow for equities to continue up higher until they reach a multiple where, it's just not enough for the Federal Reserve to promise someday down the road to cut rates. They need to cut rates or else equities are going to roll over. But that day doesn't seem to be here yet. So that's my take on yields. As for Treasury inflation protected securities, they broke down last week. This week, they recaptured support. This is stubborn. This is sticky inflation. This is telling you investors want protection from inflation. They're buying tips. They're buying gold. They're buying silver. As for the dollar, we kind of already covered this. We are at the upper band of the uptrend channel. We were here a few weeks ago. So, as I always like to say, the test is always at the top. Do we break out or do we break down? If I had to hazard a guess, it looks like we want to break out here. So, how does that bode for gold mining stocks? Not great. Not great. I have to say that. Gold held up today, was much higher, but the dollar rallied back after yesterday's ruthless sell off. It still closed up, but how long does that last for? I'm not quite sure. I don't think it does. Unless, of course, the gold market is saying that the Federal Reserve is so behind the curve on interest rate hikes that it doesn't care what the dollar does. It's going to go up anyway. Keep in mind that oil is priced in US dollars, but the correlation is nowhere near what it used to be. So maybe that's the same here that's developing for gold. I find it hard to believe, but it's possible. Let's do some comments here. Contact your congressperson and tell them no for Pelosi omnibus bill that funds. I don't even want to get into that. Trader Isaac, I hear you, brother, and more power to you. But I get sad, man. I just get sad with these communists, what they're doing. Bob, the CEO on Kramer's show last night, saying that to save over 60 million interest, which makes more profits. A CEO of FedEx? Michael? HPE is the father of AI. Okay. All right, moving on. Volatility. What's volatility telling us? VIX. Not much. It's not telling us much on a weekly time frame. It's telling us that there is no fear whatsoever in this market. On the day, though, we did put in new lower lows, but we rallied off the lows of the session. We did the transports. Dow Jones Industrial Average, new all-time record highs this week. Caveat here on the Dow, we're very overbought. We are leaning into the third standard deviation Bollinger Band. We haven't done that since back here in early February. We got a brief correction there. So warning flag on the track. SPY's weekly chart, RSI now, weekly time frame about 80. We are now tapping the upper band of the rising uptrend channel. Volume, not that great. Daily chart. Not great price action. We're very extended here. No volume to speak of. Q's weekly chart. Poised for a breakout. There yet. Volume light, daily view. Filled candlestick on the day, meaning we gapped up, yet we faded off the highs of the day. And take note of the declining up volume sequentially. Not good. We spoke about, no, we didn't speak about technology. Let's skip technology. Let's talk about semis. Semis setting up for a continuation breakout. What do they do on the day? Very similar to the Qs, gapped up but faded. Biotechs, which pulled back. Doji star formation. These may be getting ready for another run here. Maybe we'll be doing some buying of, oh no, maybe not. They reversed today. Maybe selling some puts. Consumer staples, which have been in fuego. I mean, they're up over 1 1/3% of the week. Philip Morris, I should say Altria, we're up nearly 2.5% this week. A little bit extended. Discretionary names coming back to life. Buy now, pay never. Saving the group. Emerging markets, I don't care about EDC. That includes China. We don't want any China. Up 1.25%. Energy stocks up nearly 2%. So think about it. You have transportation stocks moving up higher, energy moving up higher, oil moving up higher. No breakout though. Gasoline, another weekly higher high. Gasoline on the year is up nearly 29% on the year. Yet, oh, we're going to cut rates. We're going to cut rates. What are you talking about? What are you talking about? How are you going to cut rates when gasoline prices are up nearly 30% in the first quarter of 2024? What world do you live in? It's shocking. Nat gas, that's off the lows of the week. This may be a trade soon. Gold we spoke about, weekly up only a percentage point on the week now. Mining stocks, they're all down on the week. But longer term, I'm very, very bullish on these names. Very, very bullish. We own them. Silver, failed breakout. Okay. Bob, which companies of charts that you like? Well, I did a whole bunch of them on, like one of them from last week was Nucor. I do the best stock charts each week. And Nucor was one. That's up 4% this week. What else do we like on the week? Let me go back. Cooper. This is a copper play. This is from one of our fellow members, Franklin. It just so happened it appeared on one of my scans. That's up 3% on the week. RYA, Ryanair, RYAAY, European company. That's up nearly 3% on the week. Zebra Technologies, I haven't looked at this one since I spoke about it last week. ZBRA, that's up 3.22% on the week. RJF, that's up 4.42% on the week. So those were our best stock picks going into the new trading week. I added Adobe because it got beat up last week. I don't know how it's doing so far this week. That's up 4%. So those are the names that I liked going into the new trading week. We'll come up with a new batch this weekend. So if you're not currently on our email list, enter your email address below, or I'll post it on YouTube and just click the notification bell, like, subscribe, all that jazz. What else do we want to do? Let's do some chart requests and we will wrap this up. Let's talk about some stocks in the members area. Ticker Cloud. We have a couple to go over here. Not many. We have a little bit of time left. You want me to go over a chart or two? Drop the quote in there or the ticker symbol, and we will talk about it. All right, first chart up is Riot Blockchain. I haven't looked at this one in a while. Let's go back to the monthly chart to get a vibe for where it's. I'm surprised this hasn't moved a lot more. Very tight consolidation on a monthly time frame. Really tight consolidation here. I'm kind of bullish on this. I like it. I'm bullish. For Michael, HPE. I don't like this wick on top of this candlestick. Otherwise, it looks good. It's trying to break out of a monthly base. Weekly chart. It's looking good. It broke out today. Bullish. Looks good. I think it goes up. AAL. I'm not an airline, guys. I prefer Ryanair if I had to go with one, but okay. AAL. It's done nothing for a few years now, and I don't see it doing much. I'm not a buyer here. It had a failed breakout last spring. Perhaps there's some seasonality that helps AAL. Yeah, May, when it broke out last year, this is seasonality going back 13 years. May is one of the better months out of the year. Not great, but one of the better months. And not so oddly enough, the last time you saw a breakout on American Airlines was actually back here, I should say January. And then we did a retest and we broke out May, June of last year. You know, maybe we'll get a continuation breakout this May. I don't love this stock. I don't like American Airlines. I don't like any airlines per se. It broke out today, but I don't have a lot of hope for it. Too many other good plays out there rather than an airline. Yeah, Duolingo is a good one. Yeah, I want to go over that one. I use it. I haven't used it in a couple of months because I started learning Italian, and then I stopped. They send me text every day. It's been 30 days since you practice your Italian. Oh, this is gorgeous. This is gorgeous. This wants to break out. So here's what I'm seeing. Pop, pop, wedge formation. I'm a buyer here. Daily chart. I would wait. Sorry, got to backtrack. Bearish reversal today. Wait for retrace. Maybe back down to VWAP at 222 spot 76 in that ballpark. Obviously, that changes. But Duolingo, I love as a product. Great stock. Can't say enough about it. Yeah, but Michael, Boeing said you can't. For American Airlines, you can't blame Boeing. I mean, American Airlines has been stuck in the mud forever. Now, granted, Boeing's had its own issues, but Boeing began to rally. Then it faded. You know, on bad news, American Airlines never really rallied except for that back-to-back spring rally last year. Other than that, it's been a dog with fleas. So, you know, I wouldn't give it a get out of jail free card due to Boeing. I mean, hell, even Boeing has been showing some strength this week, and that company can't get out of its own way. Yeah, it's up on the week. So I wouldn't buy Boeing. I wouldn't buy American Airlines. U.S. I think they were in copper. Hold on. Let me check. You could be right. The services are rallying as well. Financial services sector. You're probably right. You are right. I was wrong. Finance Consumer Loans Group. Thank you for the fact check. Always value that. Hate giving out bad information. We stand corrected. US dollar, Japanese yen. Okay, so all right, so one of the other reasons why I've been struggling this past week with deciding what to trade is because of the relationship between the Japanese yen and the US dollar. The Japanese, for the first time in decades, raised interest rates. They stopped yield curve control. And what happened? The yen collapsed to new multi-years, if not all-time lows versus the US dollar, at least using the FXY. Actually, we were lower back in October, but we're right there. I mean, you normally don't get a collapse in the currency when you begin to raise rates. It doesn't make sense. The dollar gained strength on the Japanese raising interest rates. That's what leads me to believe that this is probably a lot of hype. Probably a lot of hype. So I think that the Forex markets are sniffing it out. I think the bond market's kind of sniffing it out. And I don't think it could be made any clearer that the Japanese yen should have rallied this week, but it did not. What did it do on the day? I mean, it's a train wreck. Light volume, though. But absolute opposite of what I expected. When I heard they raised rates, and I was at the gym about 5 a.m., 6 a.m., and I fully expected to see the dollar falling, gold rallying, and yen rallying. Didn't happen. All right, let's leave it off with So and honestly, when I see, usually I have a very, very good pulse of the market. I know that 2 plus 2 should equal 4. But when it doesn't, as they said in, what was it? They used the phrase in, not Wolf of Wall Street, the other one about the financial collapse. 2 plus 2 equals fish. And I always laugh when I hear that. To me, the dollar strength, yen weakness, it just doesn't make sense. 2 plus 2 equals fish. It doesn't make sense. So somebody's got to show their hand here, and it's not happened yet. So therefore, I don't want to put a lot of capital to work in any one direction, because I worry that if somebody wakes up to this, you're going to see a major move in the equity markets. And don't forget, we're sporting a 35 handle on the Shiller PE ratio. It's very expensive. So I worry. All right, folks. I want to thank you for being here. Talon. Yeah, we're right there. Yeah. Thank you all for being here. Like, subscribe. You know the deal. Join us on Best Stock Charts for the new trading week. Enter your email address anywhere below. I'll send it to your inbox. Also, sign up for our, you click the bell button or subscribe, and you get notified of when we go live on Sunday Night Futures Live. Members, I will talk to you tomorrow about our trade on, we're going to definitely be trading Lululemon tomorrow morning, and quite possibly FedEx. Michael. All right, last one up for Michael. GCT. GigaCloud. Small cap. I don't know this company. Give me a moment to absorb it. Not a lot of data here. Weekly view. It's had a heck of a run here. You're rolling over, but all right, so when I'm in a situation like this, obviously you have a stock that's a good stock. I don't know the fundamentals, but the chart is telling me pretty much what I need to know about the company. It's got something that the public wants or the consumer wants, whoever their customer is. So when I see something like this, and it appears to be, at least on momentum, rolling over, RSI is clearly rolling over, Stokes have clearly rolled over here, and we've folded off or come off the top of its trading range. Now, however, it's still holding the lower band of its trading range. It could be forming a bull flag setup. So what you want to do in a situation like this is not much. All you want to do is satisfy your impulse. If you have an impulse that you must have this stock as a part of your portfolio because of whatever reason, that's fine. We've all been there. Scratch the itch. And what that means is that, let's say your intended allotment is going to be 100 shares. To begin accumulation of that 100 shares, this is not a bad spot to do it. I would buy 5 shares. Very, very small. So that way, if you take out the lows of the week, you stop out with a small loss, no big deal. No bruised ego. You get out quickly. Now, what if it doesn't take out the lows of the week and it holds this lower band of support? Okay, you're in. Now you wait. You wait until you finally break out above this upper band of resistance. Week 1 of the breakout, you nibble a little bit more. Retest of the breakout point, because you don't always get that. Normally you do. Successful retest and then a follow through to the upside. You get a little more aggressive and you finish your buying. That's what I would do here on GCT if you're in love with it. If you're not in love with it and you want to show the patience, wait for the breakout. Let all of this momentum going in the wrong direction resolve itself. This could easily hook back up. RSI could easily hook back up. It looks bad now. It doesn't mean it's going to look this way a month from now. Could easily hook back up if the market stays strong. So that's my take on it. Hope that helps. And yeah, Talent, I could see your point, but we have a market that's broken down, and you as well as anybody else should know that we've seen, because we talk about it every night, that we've seen it here. Let's bring it up. Let's bring up whatever. Let's bring up, what do we have here? Qs. Let's bring up Qs. Okay. We broke down here in December, rallied, broke down here, rallied, broke down here, rallied, broke down here, rallied, broke down here, rallied. It's the Michael Myers market. So I don't want to say, I agree with you. At this snapshot in time, that stock looks like momentum is rolling over. Would I short it? No way. Would I get aggressively long? I would just refer back to what I just said earlier. Nibble if you're looking to get long of the stock, buy the breakout, because Talent's correct. There is reason to be a little bit of concern. And all right, everyone. Folks, thanks for being here. I really appreciate it. And everybody have an awesome night and a profitable trading day tomorrow. Have a great weekend. I'll talk to you soon. Be well.